Hey everyone, welcome back to today's video. Today, we're going to check out this very interesting video, and hopefully, you'll learn something new along the way. Let's dive right in. Don't forget to leave a like, subscribe, and share your thoughts in the comments. And now, without further ado, let's get into it.
The market is speaking to you through price action, but you are not listening, and this is costing you money. So let's change that. These strategies will show you how to day trade with nothing but price and volume, using some basic smart money concepts. The first price action strategy relies on market structure and institutional trading behavior. This is the model we are looking for. So let's break down a buy signal step by step. The first thing to spot is a break of structure. This happens when price moves decisively through a previous significant low. We see a downward trend that breaks below a previous low. This break of structure signals a potential continuation in the overall trend. It shows that sellers have overcome the previous support and may be gaining control. After the break of structure, we look for a change of character. This is when the market behavior shifts noticeably. In our example, the price moves up strongly after breaking the previous structure. The change of character is critical because it confirms that the break of structure was just a fake out. It shows that there's real strength behind the move. But on the upside, at this point, traders who were short start to realize they might be on the wrong side of the market. Then we identify the last area of supply before the change of character. This area becomes significant because it's the last place where sellers were in control before the buyers took over. This area is marked as a possible new demand zone. This is a key price action concept. An area of supply, meaning selling pressure, has now flipped to become potential demand, meaning buying pressure. Big players often use these areas to enter trades. The final step is to wait for a pullback to the area we've marked, and then enter when we see a bullish candle with higher volume than the previous candles. The higher volume is our setup confirmation. It implies that there is strong interest from buyers at this level, increasing the chances that the upward move will continue. The psychology behind this is simple. The pullback allows traders who missed the initial move to enter, and the increase in volume on the bullish candle suggests that institutional traders might be entering or adding to their positions here. So this price action strategy is mainly based on simple market structure movements. It assumes that large institutional traders move the market in ways that often trap retail traders. The initial downtrend and break of structure can be seen as a stop hunt. Large players push the price down, triggering stop losses of buyers. This allows them to enter long positions at better prices. Once they've stored their positions, they push the price up sharply, resulting in the change of character. This catches many traders off guard, especially those who just entered short positions, thinking the downtrend would continue. The pullback to the last supply area could be considered as another trap. Many will see this as a chance to enter short positions, thinking the uptrend was just a temporary move. However, smart money uses this pullback to add to their long positions. This strategy works because it aligns you with the movements of smart money and also takes advantage of market psychology. The break of structure and change of character creates a fear of missing out among traders who missed the initial move. This often leads to a strong trend as more and more traders pile in, and the pullback to the last supply area provides a relatively low-risk entry point. The stop loss can be placed just below this area. Here's another signal. The first step is spotting a break of structure. This happens when price pushes through this previous low, signaling a possible continuation in trend. Next, we look for a change of character. This is when the market really starts to show its hand. Again, you need to understand the psychology behind this setup. Many traders get caught on the wrong side when the market suddenly changes direction. The third step is key. We mark the last supply area before the change of character. This area is special because it's the last place sellers were in control before buyers took over. In price action terms, this area flips from being supply to potential demand. Potential because we don't know yet. The price might break this zone in many cases. That's why the pullback to this newly marked demand area must fulfill the most important condition. The entry signal comes only if we see a bullish candle with higher volume than previous candles. This increased volume means there's strong buyer interest, hinting that big players might be getting involved. Now let's break down the steps for a short signal. The first aspect to spot is a break of structure, but now we're looking for a break to the upside. So we need to see that price moves upward through a previous significant high, signaling a potential trend continuation. It's like the market is testing the waters, seeing if it can continue its previous direction. This time, the break catches buyers off guard, those who were betting on the continuation of the uptrend. After the break of structure, we need a change of character, but now in a bearish direction. This is when the market behavior shifts to the downside, breaking a major swing low. This price action movement confirms that the break of structure was actually a fake out, a trap for buying traders, and also shows that there's real strength behind the downward move. At this point, traders who were long start to realize they've entered at a bad time, and this can lead to some selling as they try to exit their positions, further fueling the downward move. Next, we identify the last area of demand before the change of character. This area becomes significant because it's the last place where buyers were in control before the sellers took charge. This is an important concept. Once an area of demand has been broken, it flipped and became a potential supply, so a possible zone with selling pressure. And we already know that big players often use these areas to enter short trades. The final step is to wait for a retrace to supply, and then enter the short position when we see a bearish candle with higher volume than the previous candles. The higher volume is your confirmation that there's strong interest from sellers at this level, increasing the likelihood that the downward move will continue. The increase in volume on the bearish candle basically means that smart money might be entering or adding to their short positions here. You'll see this pattern every day, multiple times, on all markets and all time frames. The final break of structure can be seen as a stop hunt. Large players push the price up, triggering stop losses of sellers. This allows them to enter their short positions at better prices. Once they've absorbed all the liquidity, they push the price down sharply, resulting in the change of character. As I said, this catches many traders off guard, especially those who just entered long positions thinking the uptrend would continue. And the retrace to the last demand area can be seen as another trap. Many will see this as a chance to enter long positions, thinking the previous downward movement was just temporary. But the smart play here is to use this pullback to find a short signal. Another example. First, we're seeing a break of structure to the upside. We see price moving above a previous significant high, indicating a potential continuation. When price breaks above these levels, it triggers a cascade of new buy orders. At the same time, the stop losses of sellers are hit, and this creates liquidity for smart money to engineer their plan. After the break of structure, we see a change of character in a bearish direction. This is when the market behavior shifts to the downside. The price moves down strongly after breaking the previous structure, It confirms that there's real strength behind the downward move. Next, you look for the last area of demand before the change of character. The last place where buyers were in control before the sellers took over. So this previous area of demand has now flipped and then became a potential supply. We wait for a retracement to our new supply zone and then enter the short trade when we see a bearish candle with higher volume than the previous candles. It's the confirmation of strong interest from sellers at this level. This is a low-risk entry for a short trade. Now, very important, when you spot a setup like this one, consider the larger context of the market. This setup, the break of structure, change of character, and the flip of supply to demand, could very well be part of a larger uptrend, marking the end of a pullback. And trading this setup as a continuation of the previous trend, rather than a reversal, is often the smarter move. Trends tend to persist due to market momentum. When you trade this setup with the trend, you're aligning with the order flow. So at the end of a pullback, this setup is actually a continuation trade in the direction of the main trend. The overall trend shows where the big money is flowing, and it's usually safer to go with the current trend rather than against it. In this example, the market has been in an uptrend for some time. We're seeing higher highs and higher lows. Then we see a pullback. This pullback might look significant on a smaller time frame, but in the context of the larger trend, it's just a retracement. Toward the end of this pullback, we see our setup unfold. First, the break of structure. Price breaks below a previous low. Then the change of character. A strong move up. It signals that the pullback might be over and the uptrend is ready to resume. Then we have the flip from supply to demand. The area just before the change of character, which was previously supply, now becomes potential demand. This is our key level to watch for potential entries. As price pulls back to this demand zone, this is where we look for our entry, confirmed by a bullish candle with higher volume. So by entering here, we're not trying to catch a reversal. Instead, we are joining a trend that's already in place. We're essentially betting that the larger uptrend will continue after this retracement. The rejection block strategy is the second price action method, capitalizing on the behavior of large institutional traders. So let's break down this strategy step by step. The first key element of this method is spotting a 2-wick rejection. If there are more wicks, even better. This occurs when we see at least 2 consecutive candles with long wicks extending in the same direction. These wicks represent failed attempts by the market to move prices higher or lower. In the context of a downtrend, We are looking for minimum 2 candles with long upper wicks. These wicks show that buyers tried to push the price higher, but sellers came in with enough force to reject those moves, pushing the price back down. The psychology behind this is simple. These rejection wicks often form at significant price levels, where large players have placed sell orders. As the price moves up into this area, it triggers these large sell orders, causing the quick rejections we see as wicks. The next crucial element is the presence of high volume on the candles containing these rejection wicks. Volume is the best indicator to see the level of participation and the interest in a particular price move. High volume accompanying these rejection candles implies that there is significant selling pressure at this level. It's not just a few traders causing these rejections. There's substantial market interest here. So basically, high volume on rejection candles often indicates that smart money is active. These large players typically need high volume to execute their large orders, without causing dramatic price spikes. For many traders, seeing high volume can be misleading. They might interpret it as a sign of strength in the most recent trend, not realizing that in this context, it's actually showing strong selling pressure. Once we've identified the 2-wick rejection and confirmed high volume, we can define the rejection block. This is the price range encompassing the wicks of these rejection candles. The rejection block represents a zone where selling pressure has overwhelmed buying pressure. It's an area where the market has shown it's not yet ready to accept higher prices. Those who bought near the top of this range are now potentially sitting on losses, creating a pool of traders who may be eager to sell if the price returns to this level. For traders who missed the initial move down, this rejection block becomes a potential entry area for short trades on any future retests. And after the initial rejection and the subsequent move lower, we often see price returned to retest the rejection block. This retest will invalidate or confirm the strength of the resistance and potentially entering a short trade. The retest happens for several reasons. Traders who missed the initial move down see this as an opportunity to enter short positions. Some bullish traders still believe in the uptrend and try to buy what they see as a dip. Smart money often uses these retests to add to their short positions or to trap more retail traders into long positions before pushing the price lower. Look for signs of rejection at this level, such as bearish candlestick patterns or another push lower on high volume. Entering at this point allows you to ride the next wave of selling pressure. You place your stop loss above the rejection block. This level has already shown strong selling pressure, so a move above it might indicate that the setup has failed. For take profit, you can use previous areas or key technical levels below the current price. Let's look at another signal. First, we're looking for a rejection of higher prices. And here, the market tries to move up, but gets pushed back down, showing potential selling pressure. We spot several candles with long upper wicks. These wicks show where buyers tried to push the price up, but sellers stepped in and pushed it back down. This means there's strong selling interest at this price level. Next, we want to see high volume on these rejection candles. High volume means lots of orders were placed. It's not just a few random trades. It's a big group of sellers saying no to higher prices. When we see big volume bars with these rejections, it adds weight to our idea that this price level is important. After we spot the rejection wicks and confirm high volume, we mark the rejection block containing the wicks. This rejection block will be our key resistance level, where sellers have shown they are ready to jump in. Now comes the waiting game. You could enter after the rejection candles. There's nothing wrong with this trade if the rejection block happens at the resistance. But let's say we missed this initial trade. We then have to wait for the price to move away and then come back to test this level again. This retest is important. It shows us if sellers still think this level matters. While we wait, we are watching to see how the price acts near this level. Does it start to slow down as it approaches? Do we see little hesitation candles? These are signs that traders remember this level and are getting ready to act. When price comes back to test the rejection block, we pay close attention. We are looking for signs that sellers are still interested. This might look like another rejection wick, a series of small bearish candles, or a sharp drop off the level. If we have this confirmation, we short the market when price retests the rejection block and shows signs of respecting it. Let's talk a bit about the mechanics behind the pattern. To really get this strategy, you need to understand what's happening in the market. First, we have resistance. The rejection block acts as a resistance level. In price action trading, resistance is where selling pressure overcomes buying pressure. Then we have market memory. Traders often remember important price levels. When price returns to a level where it previously turned around, many traders will be watching to see if it happens again. Then we have order flow. The rejection wicks and the subsequent drop implies that there are large sell orders placed at this level. These orders absorb the buying pressure and push the price back down. And finally, there's the trend continuation. Often these rejection blocks form during bounces in a larger downtrend. By entering on the retest, you are trying to catch the next wave down in the trend. This rejection block strategy taps into how traders think and feel. First, there's the fear of missing out. As price approaches the rejection block again, the traders who missed the first drop may be eager to enter, adding to the selling pressure. And we have the pain of regret. Buyers who got stopped out on the initial rejection may be hesitant to buy again at this level, reducing buying pressure. Another trait, we notice two candlesticks with long upper wicks near a recent high. These wicks stand out because they are much longer than the wicks on nearby candles. Then we check the volume for these candles and see it's significantly higher than the average volume of the past few candles. Next, we draw our rejection block as price moves lower, away from this level. As price approaches the rejection block, you notice it starts to slow down. The candles get smaller, showing hesitation. Then price touches the rejection block and immediately forms a bearish candle with another long upper wick, similar to the original rejection candles. So the play here is to sell as the bearish candle closes, placing your stop loss just above the rejection block. The same for a buy signal. The first step is to spot two or more candles with long lower wicks. Sellers tried to push the price down, but buyers stepped in and pushed it back up. This action reveals strong buying interest at this price level. Buyers were ready and willing to defend this price zone. Also, we want to see high volume on these rejection candles. Again, when we see big volume bars with these rejections, it adds weight to our idea that this price level is important. After spotting the rejection wicks and confirming high volume, we draw the rejection block. This area will act as a key support zone where buyers have shown they're ready to jump in. Then we wait for the price to move away and then come back to test this level again. This retest shows us if buyers still think this level matters. While we wait, we're watching to see how the market acts near this level. Does it start to slow down as it approaches? Do we see little hesitation candles? These are signs that traders remember this level and are getting ready to act. Basically, we are looking for signs that buyers are still interested. Maybe another rejection wick, a series of small bullish candles, or even a sharp bounce off the level. If you see signs of rejection, you enter a buy trade. Another buy entry. We found two candlesticks with long, lower wicks near a recent low. These wicks stand out because they're much longer than the wicks on nearby candles. Then we check the volume for these candles and see it's significantly higher than the average volume of the past few candles. Then we draw our horizontal lines at the bottom and top of these wicks, marking the rejection block. As price approaches the rejection block, it starts to slow down. The candles get smaller, showing loss of momentum. Then price touches the rejection block and immediately forms a bullish candle. This candle has a higher volume than the previous candles. So once again, this is a sign of strength. So the play here is a long trade as the bullish candle closes, placing your stop loss just below the rejection block. Now, when trading rejection blocks, you need to know that price movements aren't always perfect. Sometimes the market might briefly dip below your identified rejection block before bouncing back up, but this doesn't necessarily invalidate your trade setup. Market noise is a major factor for this. Short-term price movements can be influenced by big orders or algorithmic trading. These can cause brief dips below your rejection block. There's also stop hunting. You know that big players like to push the price below obvious support levels to trigger stop losses before reversing the move. A short break below a rejection block could simply be a shakeout of weak hands, and sometimes the market needs one last push lower to confirm that buyers are still interested at these levels. To deal with these situations, instead of entering as soon as price touches the rejection block, wait for a candle to close above it. And keep in mind that a true breakout of the rejection block often comes with high volume. If you see price moving below your rejection block, but volume is low, it might be a false move. And maybe you should check multiple timeframes. A break on a smaller timeframe might not mean much if the larger timeframe still shows a strong trend in your favor. That's why, when you place your trade, consider adding a buffer below their rejection block. Instead of placing stops right below the block, you might place them slightly below to account for these brief dips. Now, if you're ready for more smart money and price action methods, go ahead and watch one of these videos.